Do you think the market's worries about a hawkish Fed are overdone, or is it time to take risk off the table for 2022?
So I think the market has it right. I mean, there's been so much signaling from the Fed in terms of kind of moving towards this hawkish pivot, if you will, that it is priced in. It's appropriate. The Fed is going to execute, I think, what the market expects, which is a more rapid taper, and they're not going to push back too hard on the rate hikes that are being built into the market. Kathleen said it correctly. It's really a function of where they see the path of rates. And for me, signaling from both the economic projections as well as the dots in terms of where they think all of the hikes are going to end is probably the most important thing that we're going to be looking at.
Okay, and what then would constitute, in your mind, Marvin, a hawkish tilt? Because it's hard to really scare the markets at this point, who have been kind of freaked out these last 2 weeks or so, really already.
Yeah, certainly. There's a lot of liquidity in the system. So, while we have higher volatility, we certainly do still have asset values that have, for the most part, maintained most of the gains that they've had really over the course of the last 2 years. The market has been behaved because as we build in more rate hikes shorter term, we pull inflation expectations down, and we don't really increase rate expectations further out the curve. So effectively, the market is saying that what the Fed is doing is going to keep the story pretty much well packed. If the Fed starts to show that it's getting closer to this neutral rate, this 2.5% kind of magical number, which seems to be a limit on a lot of the long-term rates. Certainly our forward expectations for rates are much lower than that 2.5%. But if they get closer to 2% within the next 3 years, or even start signaling that it might need to get above 2.5% because of the inflation environment, that really is a hawkish outcome. I'd also add that there could be discussions around the size of the balance sheet. That's something that's not really being discussed right now. But if they do start to talk about QT, I think that also is a hawkish outcome from this meeting potentially.
And what does that mean for risk assets? You mentioned, things are still, when it comes to liquidity, still pretty ample right now. Does that mean one should stay in U.S. stocks for next year?
Yeah, I think so. I mean, from an earn, so we're in the camp that they're not going to ultimately do that hawkish pivot that I described. That long-term rates are going to remain relatively well contained, which really keeps real yields and term premiums low, if you will. And in that type of environment, I hate to say there's no other alternative, because certainly there's a lot of assets out there, but U.S. assets do look attractive from the perspective of a central bank that is taking action to make sure inflation doesn't get out of hand. And you've got securities that still exhibit positive earnings and cash flow potential that's stronger than a lot of other parts of the world.
Marvin, would you then say those two things, negative real rates and a negative term premium, would those be, I guess, the best forward-looking indicators for stocks?
Yeah, certainly I think so. And today was incredibly interesting because we had some weakness in the equity markets. Interestingly, even though we had this massive PPI print, break-evens went down. So that's your inflation compensation associated with bonds. But real yields went up. That tips rate the tips rate became less negative ultimately. It's where we're dealing in this strange world where we have to actually take a step back and say, so tips rates became less negative, which is they went up. And that caused the volatility. So yes, it is very, very important in that discussion. The fact that there are negative real yields do make a lot of assets more attractive than an environment where we're talking about real yields getting towards neutral or even positive, which is it's still a ways away, but certainly within things that we should be thinking about.
And in terms of sectors, you're saying tech is still in a sweet spot here. Walk us through why.
Yeah, you know what? I am one of the tech fanboys out there. I think that when you paint a picture where growth is dear, which is certainly what we came from before the pandemic. And to a certain degree, it's a signal in terms of how flat the curve is that once we get through this, growth is still going to be a dear thing that you want to own. Tech is in a sweet spot in terms of their ability to grow. Lower yields and certainly negative real yields also support duration. So I think that is part of your discussion as you go forward. There's certainly other sectors that might benefit. I do think that there are places around the world. I work with a team of very smart equity analysts, and they're looking at industrials in Europe. They're considering whether or not the industrial complex in Japan benefits from the way the supply chains are evolving. But U.S. stocks, in our view, remain a key component of that discussion.